Let's delve into the modern way to incorporate gold and silver into your investment strategy. ETFs. ETFs offer a streamlined alternative to owning physical gold and silver. They provide exposure to these assets without the complexities of storage and security. ETFs are traded on stock exchanges, allowing you to buy and sell shares throughout the trading day. Conduct thorough research before investing in gold and silver ETFs. Popular ETFs like SPDR Gold Shares, GLD, and iShares Silver Trust, SLV, offer straightforward ways to gain exposure to gold and silver. These ETFs provide diversification benefits and potential inflation hedging properties. Gold and silver mining ETFs invest in companies involved in the exploration, mining, and production of these metals. The VanEck Vectors Gold Miners ETF, GDX, tracks the performance of global gold mining companies. Investing in mining ETFs can offer leveraged returns compared to ETFs that track the spot prices of gold and silver. However, it's essential to note that mining companies can experience amplified losses when gold prices decline. Gold and silver share a fascinating history as stores of value and safe haven assets. Gold commands allure and mystique, sought after during times of economic uncertainty. Silver boasts a vibrant industrial demand profile, making it indispensable in countless industrial processes. Understanding the nuances of this dynamic interplay is crucial for investors seeking to harness the unique characteristics of each metal. Section 2. Decoding the gold to silver ratio. The gold to silver ratio, a closely watched metric by precious metals investors, quantifies the relative value of these two metals at any given time. It represents the number of ounces of silver required to purchase 1 ounce of gold. For instance, a gold to silver ratio of 80:1 indicates that 1 ounce of gold can be exchanged for 80 ounces of silver. This ratio, far from static, fluctuates over time, influenced by a confluence of factors, including supply and demand dynamics for each metal, investor sentiment, economic conditions, and geopolitical events. Understanding the historical trends and current levels of the gold to silver ratio can provide valuable insights for investors seeking to optimize their precious metals allocations. Historically, the gold to silver ratio has averaged around 50:1, meaning that, on average, 1 ounce of gold has been equivalent in value to approximately 50 ounces of silver. However, this ratio has exhibited significant deviations from its historical mean, creating potential opportunities for astute investors. When the ratio widens, implying that silver is relatively undervalued compared to gold, it might present a buying opportunity for silver. Conversely, a narrowing ratio suggesting silver's outperformance relative to gold could signal a potential selling opportunity for silver or a buying opportunity for gold. The dynamic relationship between gold and silver, as reflected in the fluctuating gold to silver ratio, presents both opportunities and challenges for investors. By understanding the historical trends, current market dynamics, and your own investment objectives and risk tolerance, you can make informed decisions about how to allocate your capital between these two precious metals. If you believe that silver is undervalued relative to gold, as indicated by a high gold to silver ratio, you might consider increasing your allocation to silver. This strategy, often referred to as trading the ratio, involves buying silver when it's relatively cheap compared to gold and potentially selling it later when the ratio narrows, implying that silver has outperformed gold. However, it's crucial to remember that trading the gold to silver ratio, like any investment strategy, involves risks. The ratio can remain elevated or even widen further for extended periods, testing your patience and conviction. Moreover, predicting the future direction of the ratio with certainty is impossible, and unforeseen events can disrupt even the most well-researched forecasts.